Good morning, everyone. Happy Friday. It is the last trading day of the week. It's October 10th, and we just started earnings season. I guess we could officially say it started because Delta announced yesterday, as well as others like Levi, and Delta announced good earnings. Their stock price rallied. Next week, it's going to get much, much busier with big banks announcing, as well as some other companies like TSM is going to announce next week. That should be huge news. So this is kind of the last easy week for a while. And if you're a stock fan, it's kind of like the busy earnings season kind of feels like the playoffs. I know we're in the playoffs with baseball, exciting finish between the Dodgers and the Phillies. The Dodgers took that series and move on. They're going to play the winner of the Milwaukee-Chicago series, and we'll see who ends up in the World Series on the National League side. Well, it feels a little bit like playoffs when we talk about stocks and we get into these earnings, because the earnings will move stocks higher, lower. It'll really set the table for what the market's going to expect. We've had a terrific 3 years, and from what we're observing, I think the earnings are going to come in favorable, but there'll be some areas that will really be in focus. The area that I think is going to be highly in focus is going to be the data center spend. When the big hyperscalers being Amazon, AWS, Microsoft, Azure, Google Cloud, and others, when they announce their guidance toward their data center operations, that's going to move the markets. If they say, hey, we're at full capacity and we can't keep up with demand, we're going to have to figure out how we can build more data centers and all that good stuff, then the AI build out rally is going to continue. It's just going to add a little more, fuel to the fire. As opposed to if they are more conservative and are like, hey, you know what? We got good demand, but we're not expecting an overly fast, growth rate in the data center. Then the opposite. We'll see. We'll get through these earnings and we'll see what happens. I'm joined this morning by my colleague, Daryl. How are you, Daryl?
I'm doing wonderful, Victor. It's good to be here. How are you doing today?
I'm doing great. I had a live stream yesterday, and your name came up in positive terms. And it also came up because I was like, hey, I kind of wish Daryl was on the stream. And in fact, one of the stocks that I'm suggesting we look at, Comcast, was one that came from yesterday's stream.
Okay.
I really wanted to see your analysis on the charts. So it's great to be streaming with you. And for the audience, we are looking at stocks. We're both investors with different methods, but we're striving for something that aligns with my own personal goals with my portfolio, and Daryl has his goals. So I come from a fundamental analysis point of view, looking at a company qualitatively. Is it a good business? Is it a desirable business? Do they have a moat? Are they the strongest in their industry? Do they have competitive advantages and barriers to lock in their growth and keep their profitability, that kind of stuff? And I go into free cash flows. Free cash flows represent the true value of a business. Over time, businesses will be measured by how much free cash flow ends up in the balance sheet. And then from there, management can decide, we're going to dividend that money back to investors. We're going to buy back shares. We're going to acquire other good businesses to make our enterprise bigger, more valuable. So that's the true measure of a company's value. And I try to forecast that free cash flow and then do a net present value determination to see what's the value per share and then compare it to current stock prices. Also look at the future profitability and do the same thing. Daryl brings in his charting analysis, and it tells us, how is that stock trending? How's it trading? Is it setting up to continue to fall or continue to rise? Or is it an opportunity potentially for it to begin to rally? And I think when you pair the two, you're getting the best of both worlds, potentially finding a quality business that is priced well. And I can show you multiple examples where the market will price great businesses at a very discounted rate, but the investor has to be patient. It may not be today, maybe in 6 months, maybe in 12 months. But if we do our homework, we wait around for the market to sell off a stock on a story. And then when that story is proven to be not as disruptive or threatening to that business, story goes away, the stock price rises. And I'll show you multiple examples of that. But buying stocks at a discounted rate, and then with Daryl's analysis, we could see how it's setting up. Potentially, we're looking at a very good period to either buy stocks or sell, or it's just very interesting to see how stocks are trending on the charts. So we hope you find it interesting. Based on feedback, I think people like this format a lot. I like it a lot. I'm one of the biggest fans of the of the stream. So that's what we intend on doing. And we have a list of stocks we wanted to cover, but would love to hear what you would like to cover. If you're a member, it comes with your membership. Just put a stock symbol in the chat. We'll go over it. If you're not a member, no big deal. You could buy a $5 super chat and we will take a look at that stock. Or you could become a member on the fly. It's easy. Then you'll become a member and you can ask for stocks to be reviewed. All right, so we're going to start talking about some news, and we have this government shutdown. I think we're going on day 10, and I think they're going to go home for the weekend. So I guess we're going to get to day 12, 13, 14 before we could possibly get out of this shutdown. How do you think this shutdown is affecting the economy, Daryl?
Well, the first couple of weeks, it probably doesn't have much of an impact, and I think the market is reflecting that. Once you get past a couple of weeks, get into a month, then you are going to start having some impact to the economy. I've even heard some numbers about for every week that you go past, a couple of weeks, for every week after that, it impacts the economy by a certain percentage. I don't remember what that is, but it kind of makes sense. If you don't have government employees that are receiving paychecks, they're not spending, the government's not traveling as much. So I can see where those kind of impacts come into play. So the longer this goes on, I think the higher chance that we're going to see some economic impact from it.
Yeah, especially regionally, right? Like the Washington, D.C. area. I imagine, restaurants and
Yep.
the economic situation there is probably being hit harder as opposed to, if you're somewhere where there's very little federal government presence, it's probably no impact. Very good. So, little Jay, good morning. You bring up a topic that Daryl and I were actually speaking about, and we will get to your item or your point in about 5-10 minutes, and we will look at that ETF. I think it's a good idea. So the shutdown's going to continue. We'll see where it goes. Now, when I think I hear a lot about, hey, what can take this stock market higher or what can take this stock market lower? So I wanted to get into a conversation there and talk about, hey, most definitely, I've been feeling like the market's rather expensive, and maybe we can start with, what could bring the stock market down a bit, and then we will go pivot over to what could take the market higher, and kind of leading the kind of the story that could take the stock market lower. It starts with stock prices are a bit expensive, and we're seeing a little too more euphoria around some stocks. Some stocks are going up 20-30% on a day, and it's on a news piece. And it's on a news piece of how in 2 years, this company is going to do really well. And it's like, okay, but you know, you're giving them full credit for something that may happen in 2 years. That's pretty generous, as opposed to earnings. Hey, this is what we did over the last 3 months. This is data. This is evidence of what we're doing. We're growing, and I think that that euphoria is creating too high of prices. Easy up, easy down. So that's one of the qualitative kind of just observations that I have, that, hey, stock prices are just getting too high, and it's too easy for stock prices to go up. It feels more comfortable for me when stocks grind higher. They earn a higher stock price. And what are your thoughts on what could bring the stock market down?
First of all, I'll say overall, I'm generally optimistic and bullish about the market, but I do see some potential opportunities to be pulling back. So we are riding this AI wave of euphoria right now. One of the things that I've been hearing a lot about, and it makes sense, is you can build data centers faster than you can power them, at least through an electrical grid without their own power source. And these data centers, as they're going up, is causing electric prices to go up, and that is impacting people, individuals. I haven't actually checked, my electric prices per kilowatt, but I hear some areas that it's up 30 or 40% compared to before this data center build out. So we're kind of subsidizing these data centers, and the power requirements could be the chokehold on all of this AI euphoria. That's going to come into play next year as we move into the midterm elections. I think you're going to start hearing a lot more about, hey, I'm paying too much for my electricity. I wasn't doing this before Meta moved in down the street, or Google, moved in across the town. I wasn't paying these high prices, so I'm having to subsidize these. And I think you're going to start hearing some pushback. So that's one thing that could come in and cause a constraint.
Yeah, and I think little Jay asked a question. We can look at this ETF after we get done with our kind of comments around what could take the market higher or lower. And I think back to like my comment on, the exuberance that I'm observing. There is like, hey, the data center build off is going to continue. OpenAI is going to form a partnership with AMD, and they're going to form a partnership with this other company, and they're going to do this thing with it. And it's like pie in the sky. Like, okay, that's great that the partnership, it should create a rise in AMD's stock price. Just to the extent that it's causing the rise is kind of completely ignoring like a good point you just made, which is, that's great that you have these data center buildings, but if they don't have any power, you're not going to run those semiconductors. It's just going to
Exactly.
be a building, and it's going to be dark. So now those are the reasons why stocks could fall. But let's kind of put a period on that, start a new paragraph. What could take the market higher? And I have heard a couple of, I think, very rational voices that, and it makes sense to me. We're going to go into a very low interest rate environment. And we have the Federal Reserve currently, the administration or the chairman of the Federal Reserve and that board, they are planning on reducing interest rates. But that's just a start. I think they're going to reduce interest rates, I don't know, on 3 occasions, and that's what they feel should be done. But President Trump is going to put in a new chairman in May. And I think his criteria or qualifications of that new Federal Reserve chair is somebody who's committed to lowering interest rates. So if we're going to have somebody that is going to really push for reducing interest rates over the next couple of years, and we have very low interest rates where we value stocks with, it's really going to help stock prices. It's going to help zero revenue companies, small caps, younger companies, riskier companies, and this stock market can go higher. Interest rates are a fundamental piece to the whole picture. So that is an expectation that I think I could bank on and believe that over the next 3 years, stocks are going to do really well. Now, this is not an economic channel where we could start looking at, well, is that going to cause a big inflation problem? Is that going to cause other issues for the economy? I think it could, but I'm really focused on stocks. How do I create value for my family and through my portfolio? So I'm seeing that as a long-term benefit to stocks, as well as riskier assets like cryptocurrencies and other assets. Your thoughts on what could take stock prices higher?
One of the things that I've been hearing and haven't researched specifically myself, but the IRS released the new tax brackets yesterday, and the reconciliation bill that was passed on July the 2nd, I believe, of this year, locked in the lower tax rates that were going to sunset and go away if they weren't renewed. As a result of all of these changes, the IRS this year had not adjusted their withholding rates. So next March, when people start receiving their tax refunds, they're probably going to have a bigger tax refund than they've had normally over the last few years. So I think we're going to see a big pocket of stimulus next March and April. As those checks start rolling in, they're going to be bigger than they have in the past. And you multiply, if it's just $500 or $1,000 more, you multiply that by how many taxpayers there are, and it's a big number. Stock investors, when they receive those checks, tend to put them into the market. So that's one driver that hasn't been talked about much, but could be a driver come next spring.
Yeah. And also, so very good point. I think, with more money in wallets come springtime, that is going to help the economy. The other big factor that I looked at, housing tends to drive a lot of economic activity. And where I'm going to go is you have regions of the United States where the homes were built a long time ago. And the regions include a good part of the Northeast, like state of New York, state of Pennsylvania, Michigan, California. And these places have many, many homes that were built a long time ago. And as the people that own these homes, in many cases, they're older and they either move to assisted living home or they pass away, and then the heirs, sell the property, and a younger family typically, or a younger person buys that property. Well, they want to recondition the property. They want to redo the kitchen, redo the bathrooms, flooring, all kinds of big spend. Combination of low interest rates. Hey, I'm going to go ahead and redo the whole thing because I have this home equity loan that's really low interest. Or I'm going to redo the home, then refinance it in 2 years. That kind of thinking, that kind of optimistic thinking happens. And, businesses that manufacture building materials, distribute building materials, retail building materials are going to benefit. And that's a big, big, tailwind for the economy. So I'm hearing some things that, the next 3 years, call it, I am feeling optimistic that stock prices are going to go up. I'm just a little worried that this AI build out is just, it's traveling at a speed that is just unsustainable. We're going to get pulled over by the cops. We're going to run out of fuel because you know what? We're just, when you drive a car at 125 miles an hour, you are consuming a lot of fuel. It feels kind of cool when you're going that fast, but you're consuming a lot of fuel. And when you're stranded on the side of the road waiting for AAA to bring you a gallon of gasoline so you can limp to the next gas station, you realize maybe we could have been traveling a little slower. So we'll see. It's a good conversation to have. And those are good opening comments. I think what we can do is get into the one request that came in, XLE. I think it's an interesting conversation piece to get into. And before I forget, DJ Stocks is the newest member of the channel. Thank you, sir, for joining. If you have a stock you'd like us to look at, please put it in the chat. And I put my email address in the chat as well. Email me. I'll get you all set up with the perks that align with your membership. Thank you very much. And Falls Grave wants to look at CLBT. Glad to do it. Good to see you. CLBT. So let's take a look at I think it was XLE. And I think he wanted to see if you could look at the charts. Could you take a look at the charts?
Yeah, I can. I want to talk about his question a little more at the moment. Because he specifically said, given the massive energy requirements for powering data centers, are you holding any energy stocks? Keep in mind that energy and utilities are different. So energy is usually oil related and your big oil providers, and certainly that could come into the play. But where I see the biggest impact is on the utility side. So your conventional electricity, nuclear power, etc. So I don't see, I'm looking at a 1-year chart right now. I can go out and look at a 5-year chart. This pretty much hasn't gone anywhere, XLE. But let's take a look at XLU. That's a whole different story. So this is the one I'm playing most heavily and have played, and I'll tell you how I'm playing it. The first, I've mentioned this in a previous stream, but I own Entergy electricity company because they're my local energy provider, utility provider. So I bought enough shares of them when I bought my house here in Arkansas. I bought enough shares of them where their dividends would cover my electric bill. I didn't know it was going to turn into an AI stock and turn into one of my best performers overall. I think I'm up 95% on this on my current holding, and I'm up 128% on my current holding. I made an annualized return of 55% on a electric company. Another way I'm playing this one is through a closed-end fund called UTG. And I am up 37%. I've only held this since October of last year, but I'm up 37%, and they pay a dividend because it's a closed-end fund. UTG. UTF gets the most press, and it looks like it could be pretty equivalent to this one, but this one is blowing UTF out of the water right now. So I get a yield of 5.86% on this one, and had a price increase that's been 23% this year. So that's the way I'm playing the power data stocks. The UTG is abroad. They invest in a lot of different utilities, including ETR, which I own directly as well. But they own a broad swath, so I don't have to pick the winners. I'll let them pick the winners and pay them an expense ratio to do that for me.
Very good. There is one opportunity that I see, and so it is true that utilities are really where the power is coming from that we all use, and these data centers are going to depend on. But I would say that if we're going to have incremental growth in the amount of power we're going to produce, the quickest way for a data center to get power is to buy natural gas and buy turbines and then run those turbines on natural gas and then create power. In fact, if we look at power generation in the United States, the number one energy source is natural gas. So it's pretty much going to be, in my opinion, the energy source to create this incremental power that is expected. It's not going to be nuclear because that takes a long time. Nuclear has to be safe. There's no ifs and buts about it. You don't want like, oh yeah, nuclear reactor melted down, created a bunch of radiation, and here we go. That's just not going to happen in the U.S. And it's very strict, high quality, very regulated as it should be. So having said that, and solar can't run at night, right? So natural gas, and I have some personal experience, or I should say professional experience. One of the jobs I had way back when, this is going back about 30 years ago, I was a financial controller with a pharmaceutical device company. We had this big factory, and we, to give you a visual, what an insulin bag looks like, right? It's a bag made out of a resin-like material and has fluids in them that are completely sterilized and can go directly into the bloodstream. And we had variations that had different medicines in them and drugs for use of hospitals. It had to be fully sterilized, and the sterilization process required a lot of steam, a lot of energy. So we had 2 gas turbines running, And yours truly modeled the gas turbines and how efficient they were based on the time of day. And I also led the negotiations with a natural gas company where we would buy a contract for 5 to 10 years so we can get a specific price for our natural gas. Having that experience, I understand how successful, effective these turbines are, because they run 24/7. It's pretty incredible how sturdy and long lasting these turbines are. And the natural gas is not that difficult to pipe into a data center. It's gas. It'll flow through a pipeline. So that's a very practical, rational way of expecting where the power is going to come from. Having said that, I'm going to look at two natural gas producers. One of them I've never looked at, Vertiv, and I got this list from Natural Gas, this website, and the other one I have looked at. So my thesis on natural gas producers, I have been really interested in a natural gas producer for the facts I just laid out, or the theory I just laid out, which is natural gas is going to be in higher demand. So Vertiv would be a good stock to take a look at. And the second stock to take a look at is EQT. And EQT is a stock that I have looked at, and I put it into the video for members that you should have access to. I did a full analysis on EQT. This stock is up 49%. It's up 281%. So this is, I think, where data centers are going to get their energy source to power a turbine that's going to create the electricity to make those NVIDIA GPUs, create the magical large language models and agentic AI that everybody is really looking forward to having. So those are pretty good ideas. It's, little J, that's what I consider a chess move, thinking high level, how are these big economic stories going to affect specific industries and specific stocks. And EQT, I think, is being priced at a small discount. I want to buy the stock, but it's just priced a little bit high. I would like to get a better discount, but I think I'm just going to have to bite the bullet and just start dollar cost averaging, because I don't want to wake up in a year and the stock's at 100. And then in 5 years, it's at like 200. And I'm like, man, I should have just bought the stock. Believe in your research. Believe in, what you saw coming, and bet on yourself. Bet on your research. So that's where I'm going with the natural gas trade, or natural gas trend.
Yeah. I'm also investing in the gas. I did conventional electricity first because that's the easiest to get to the data centers. Gas, nuclear would probably be the best. That's further out. Natural gas is in the middle. One of the constraints there, and timing is always an issue on these kind of trades, and it is like chess. GE, which manufactures gas turbines, natural gas turbines, I don't think can produce turbines fast enough to meet the current need either. Do you know how long it takes them to turn around a turbine?
I'm going to guesstimate, if you fast track it, a year and a half.
Yeah. So keep that in mind. It's a timing issue. So it was conventional electricity first because that was easy, and they've made big gains. Natural gas is going to be in play. Just remember, the timing is going to be important because you have a constraint. Nuclear is going to be fantastic long term. It also has a timing constraint associated with it. So the big run we've had in the nuclear, may slow down a little bit while things actually start coming online. There are some companies that are producing the small modular reactors, SMRs. None of them are what I would call mass production at this point. So that's going to be a timing issue. So it is like chess. I mean, you're thinking through these long-term issues, because if you buy something and it takes 5 to 10 years, you have an opportunity cost associated with that investment.
And when you look at EQT specifically, it looks like investors are buying this story. Okay. It's up 50%. It's up 275. So they're buying. This is a pure play natural gas company. I own Occidental and I own Chevron. Both of them are also natural gas producers, but they're not pure play. They're like, hey, exploring for oil, and they're exploring for other things. The CEO of Chevron, on an interview, he said that Chevron is looking to buy turbines and begin to monetize their natural gas reserves. So they want to go like one step further and say, hey, we will be your utility. We will, kind of like the way these big AI companies are saying, hey, so-and-so, build a data center and we will completely take all the capacity. Like Meta says that. Well, I think Chevron wants to start making deals like that. And Meta says, hey, Chevron, can you commit to getting me power at these 3 data center sites for the next 10 years? And Chevron would love that deal. They're like, yeah, we have the natural gas. We'll get it there. We will buy the turbines. We will basically deliver power at this agreed upon rate. And I think that's a good idea for the big oil companies. All right. So very interesting thread. We have Fallsgrave. We've got CLBT on the list, sir. We will cover that in about 2 stocks from now. And then Ben 10 wants to look at HUT. You got it. That is on the list. We will cover it. And Andrew Powers, if you would like me to look at Berkshire, glad to. $5 super chat or become a member, and then I could review that stock for you. All right. So let's take a look at CLBT. And that's Cellebrite. Cellebrite develops solutions for legally sanctioned investigations in Europe, the Middle East, Africa, Americas, Asia Pacific. The company's DI suite of solutions allows users to access, collect, review, extract, decode, decrypt, analyze, share, manage digital data across the investigative lifecycle of with respect to legally sanctioned investigations used in various cases, including child exploitation, homicide, anti-terror, border control, sexual crimes, organized crime, human trafficking, corporate security, and so forth. Okay, so this is a niche technology company. And just take a look at their website. Okay, so I don't know very much about investigations, but I could imagine it's a little bit kind of like a project, right? Where, investigation starts when a crime has been committed, and then law enforcement or investigators then begin their work and they go through it. So it's a collaboration. They have a case number and then they start working on it. So it makes a lot of sense. Makes a lot of sense for them to collect data. And then at some point, I imagine this data is part of the prosecution, part of the court case that will end up happening. This stock is down year to date. The 1 year, 7%. And the 5 year, it's done well. It's up 86.5%, which isn't bad. This is a small cap, 4.76 billion, revenue 436 million. Forward P of 38. Analysts think it's discounted by 16%. So let's take a look at the growth rate. Growth rate, this is a small company, $436 million of revenue. So that's a small business, small company. And their growth has been good. Not great, but good. 20% growth. Their free cash flow has been growing very well. I like the growth trend. It's going up. They're producing $150 million of free cash flow. At their growth rate, I would consider this to be worth 3 to 4 billion minus debt. Gross margins really high at 84. That is really good gross margins. Now they're not quite profitable because they're little, but that free cash flow is getting it done. So free cash flow is very good. Gross margins are excellent. Now, one of the high level kind of just looking at their marketplace, I'm a little worried about the growth rate. They are selling to city governments because this is law enforcement, maybe county, I imagine maybe even state and federal level, but probably mostly city police departments. And those sales processes could take a long time, and it could really be determined or influenced by budget. Do those cities have budget? If they don't have budget, they can't buy your solution. So I'm a little worried about that. The growth is decent, but you know who's done really well with government is Palantir. So maybe these guys could also be that good. All right. So their growth is good. Their margins are excellent, and their free cash flow is excellent. Let's take a look at their balance sheet just to see if they're a good, solid business. They are. They have $472 million of cash, but only $22 million of debt. So they're really strong on the balance sheet. So they're actually worth, 3.5 to 4.5 billion if you consider that they have a cash surplus. When we look at their market cap, they're at 4.8 billion. So they're not overly discounted. I think they're fairly priced because of their, good growth rate, but not great. They're small cap, so they get a little, it's a little riskier than a larger cap because a lesser known name. They're also going to be affected by government decisions, which could be, again, really determined by budget. And if we have budget cuts, they're not going to buy software. They're going to be like, hey, you know what? Let's do it the old-fashioned way on paper. Let's look at the forecast. So analysts think this is discounted by 16%. I'm not going to argue with them. I think that could be, they could make the case for that. They're going to keep growing at a good rate, not a great rate, because they're little, right? When you're little, you could really grow. If your solution is really valuable and returns great return on investment to whoever's buying it, the entity or the government that's buying it, these organizations are going to be like, hey, I don't care what it costs. I'm going to spend $10 and get $25 in value. We should figure out how to buy it. And so having a growth rate of 16.7 doesn't give me the confidence that their product is that good. It's good, but it's not great. Their earnings per share is 53 cents per share in 2026. And you'll need to pay a PE of 36.6, which is a little high. This stock, I'd like to see the PE at 18 to 20 because they're small, unknown. in a niche. It's not like you're going to sell investigative software to everybody. Everybody doesn't need it. Just law enforcement needs it. So this one here, it's just it's not floating my boat. It's too priced. I think it's priced fairly. And I don't know that the market's going to be overly excited or pay attention to a company that has a niche software. And maybe the market's telling us that it did really well during this, period of time, but it really has given up a lot of those gains. More recently, it's been on a rally. And if they could accelerate growth, that changes the game. They announced on November 5th. So this would be a good watch stock, but I don't think is very compelling at this time. What are the charts showing you?
Yeah, so I'd never heard of this company before, but while you were talking, I quickly drew this downtrend line, which it broke out above on August the 18th. And since that time has been on a really great run. Up until that point, it had been in a downtrend. And this is where I really like to start thinking about moving into a stock if it fits my strategy. We do have a little bit of resistance. It's approaching resistance, which would be its May highs, which it reached twice and was rejected. You could count this one in March as well. It was rejected. So we'll see if it can break above that point, which is around $20.16. If it does break above that and holds, then you don't have much more resistance until you get to their high at 26. I'm looking at the number of sellers over here on the price by volume bars, and there's not many sellers above this up until this high of 26. So if you didn't buy it here and you're thinking about buying it, I'd wait for a breakout above 20 and then watch for a run to 26.
Very interesting.
The RSI is positive, but not overbought. The PPO is also positive. The accumulation was really strong on this price bump right here, has somewhat flattened out, but the money flow is positive right now. So those are the levels I'd be watching for. And if I were trading it on a short term, I would be buying about 20 and selling around 26.
Yeah, great stuff, Daryl. So what was that key price level that if it gets up, it breaks through that, then it's should really rise?
Let me actually just draw it on the screen. That way it'd be easier to see. So somewhere
there we go. So we're
right
pretty close.
About there. So you can see it faced it as resistance, and then it broke through.
Mm-hmm.
Then it faced it as it broke down through that here. That was leading up to the tariff announcement. A lot of stocks did this in February and March. It tried to regain it, was rejected. So that's the next level of resistance in my opinion. And if it can break above there, then you can expect a run to around 26.
Great. Thank you. All right, that concludes CLBT. The next stock is HUT. And so this is EQT Corporation. 5 billion. Whoa, it's going up nicely, 8% today. EQT Corporation operates as a vertically integrated operator of energy infrastructure and Bitcoin miners in North America. The company operates through 4 segments: power, digital infrastructure, compute, and other. It also offers managed services for energy infrastructure development, such as site procurement, construction management, software automation, process design, personnel hiring, team training. So these guys are in the right place at the right time. They've been around since 2011. Yeah, they're probably nice and busy. Their stock has been nice and busy. It's up 144%. I'm expecting these guys are growing really fast. Let's take a look. Market cap, 5.27 billion. Revenue, 138 million. So you are paying up for this stock. You're paying 40 times revenue, which is an expensive ratio. PE, not too bad this year. So let's take a look at revenue. So that's weird because the trailing 12 months has given me weird numbers. So the 2024, the revenues were 143 million. It was growth of 84%. Okay. And I'm curious to see what kind of margins they have. So free cash flow, they didn't have free cash flow. It's very negative. Profit margin, really high. Free cash flow, no free cash flow margins. So the income statement provided by EQT Corporation is not very good. Let me try to get to a better financial statement. While I do that, can you look at EQT, the charts, and I'll try to find their financials on their website.
Okay. So I see it's reaching resistance right now, which was reached in September of 21 and February of 2021. It did break out for a month and a half or 2 months back in November of 2021. Since that time, it's been trading pretty much sideways after the fall into 2022. It's pretty much been sideways. Has been on kind of a run since April. So let me drop down to a 1-year chart now that we what I wanted to do is just show you why I picked these two resistance lines. One is at the peak, and one is that has been tested several times. So it's facing that right now. So it is trading above an upward sloping 20, 50, and 200-day moving average. So it does look like it has some good trend. It is overbought at the moment, so this resistance is going to be real. If it can hold that through today and maybe next week, then it could potentially run up to that higher price, which I'll have to go back to the 5-year to see where that is. That's about 91, so it looks like it could double if it receives continued momentum, but it is starting to reach an overbought condition. PPO does look good and had a bullish crossover at this point. The accumulation is looking pretty good. It's actually at a 52-week high, and the momentum looks good at the moment. So I'm trying to figure out maybe from a risk reward. It's speculative. I mean, you could buy this right now and it could run straight up and double. I mean, it did that in about a month or 6 weeks here. So it's speculative. Just as easily, it could come back down to around 29 or so, which would be what it reached back in December of last year, and has many supports over the past 5 years.
Okay, so I found their financial statement. This is where I want to focus on, and I apologize that it's so darn small, but that's what they produce. So if you can read this, not only can you be a pilot, you can be a microbiologist. So I'm going to talk you through these numbers because it's so hard to read. Let me see if I can make it bigger. There we go. That's a little better. So yeah, it's a lot better. Okay. So let's take a look at what they do, right? They're creating power, digital infrastructure, compute being the biggest. Compute is the biggest source of revenue, $50 million. And this whole power category, not that big. And then digital infrastructure, not that big. All right. So the next thing I want to look at is how profitable are they in each area of that business, right? So starting with power, which I'm sure is getting a lot of attention. They don't make a whole lot. They're making about $1,200,000 of gross margin, which ends up being about 13% gross margins. Those are terrible gross margins. I have like 4 levels of general grades. Awesome, great, phenomenal. That's 85, 90. Good, about 60%. Okay, 40%. Anything below 25% is bad. And these guys are in the bad zone. When it comes to power, they're not making a lot of money. They sell close to 10 million and they pay close to 9 million for the power. Well, that's not very good margins. All right, not a good business. Digital infrastructure is underwater. They sold 3 million of it. They paid almost 4 million for it. Well, you're not going to make money that way. Next item. This one's more profitable, compute. And this is actual hardware. These are GPUs. These are servers that are being leased out by customers that are using this infrastructure. And in this case here, the revenue is 50 million, cost is 28. Now we're talking. So they're about 45% gross margin on this business. Now that would be in the okay category. It's okay. It's not really exciting me, but it's okay. Now we get into some interesting lines. Gains and losses. They lost 100, and this is a paper loss, you could say. But what shouldn't be lost is they had to write off a lot of hardware, and they had to write off a bunch of hardware last year, which is one of the biggest risk items for these data centers, right? You think about it, right? You're buying this really expensive equipment, and if customers use that equipment and it gets used for its useful life, you completely appreciate it. Perfect. We made money, 44% margins. We're good to go. And in the case of digital infrastructure, they lose money. So it's like they're losing money on the business itself. But if you buy a bunch of hardware, a bunch of technology, and the market's like, we don't want that technology. We don't want to run our workloads on that hardware or this GPU or that CPU. And then Hut 8 is sitting there going, well, we got to get this stuff out of the data center and free up those racks because we want to put hardware there that customers really want. And that is one of the biggest risk items I see for these cloud infrastructure pure plays is if they think the market needs a particular technology, they procure this technology, and then the market moves, it shifts. It says, no, we don't like that kind of GPU anymore. We like this kind of GPU. Or, the advancements that came out of China through DeepSeek are teaching us that we don't need the expensive stuff. We need the less expensive stuff. Well, Hut 8 is like, oh, darn, I bought all the expensive hardware and now the market's saying less expensive. So that's risky. Now, remember the opening comments, if you were around for the opening comments. Some of these stocks are just euphoric. Never mind that they wrote off $100 million. Never mind they don't have good margins. Never mind that Hut 8, who's their competition, right? Of course, they have small scale data center companies like Nebius. Nebius is larger than these guys. BTBT. CoreWeave is larger than these guys, but I'm trying to kind of put them in a kind of a zone of smaller. But the big guys are Amazon, Microsoft, Google. All right, good luck with that. Long term, that's your competitor. You're like, hey, I want to start a baseball team. Wonderful. Long term, how are you going to deal with those Yankees? How are you going to deal with the LA Dodgers? It's like, well, I haven't thought that far. So you want to start a baseball team, but you're just going to be a kind of an independently kind of baseball team. That would be your best case. So these guys, their best cases, they're going to operate. They're hot right now. I don't invest in this zone right now because I think this is fun. This is a little bit of a sugar high. I just don't see it being sustainable. They're not driving free cash flow. So for my capital, no thanks. I'm doing great. I have a sustainable portfolio, and I'm going to stay out of this zone. If I was a young man, when I was a young man, I did take chances on stocks like these, and it didn't end well, by the way. This is a get in and get out kind of situation. And maybe a lot of people have already gotten in, and I can only expect that at some point, this one is going to torture. It already did. They had a really nice run when they were a Bitcoin miner, and then slam. So some investors, let's go from here, went from $60 a share down to $4 a share. That had to be brutal. I think the history doesn't repeat itself, but it rhymes. So Hut, that if you want to take a walk on the wild side, that is a stock to consider. Fundamentals don't support the stock price. I think it's caught in a zone of being really, the market being excited about these stocks. We'll see how it ends. I don't think it's going to end well, but we'll see.
Let me quickly show you the chart again now that I've added some additional information. So this looks like a stock. If you're going to, this is not an investment in my opinion. This is a trade, because I've drawn these 3 downtrend lines, and I'm going to draw one more just to give you an idea. If you have one like this, that you can trade it, and it looks like the trade lasts about a month each time. So every time it breaks out of one of these downtrends, this one you could have played for almost 9 months, maybe even a year. But some of these other ones, they only last a month. Here's one that lasted 1 month. Here's another one that lasted 1 month, maybe 6 weeks. This one lasted about 4 months. So you see, this is not a buy and hold. This is a trade. You could play this one. I'm expecting about 1 month. It looks like you have about a $50 upside compared to about a $10 downside at the moment. But I'd put a tight stop loss on it and don't play it more than a month.
Thank you, sir. And Magical Self, thank you so much for becoming a member. Please email me. I put my email in the chat earlier, and I'll get you set up with perks. Thank you so much. And if you want us to look at a stock that you're interested in, please put it in the chat. Thank you. All right. So we're moving from Hut to VRT. And I think we're going to stay with this, I think, in this neighborhood of discussion. Vertiv Holdings designs, manufactures, and services critical digital infrastructure technologies and lifecycle services for data centers, communication networks and commercial and industrial environments in the Americas, Asia, Europe, Middle East, Africa. The company offers AC and DC power management products, switchgear and busbar products, thermal management products, integrated rack systems, modular solutions, management systems for monitoring, controlling digital infrastructure. Let's take a look at their website. Okay, so this is a company. Let's see what they actually produce. So they do solutions. So they're doing uninterruptible power supplies, energy batteries. And this is for backup. This isn't for like you're using them normally. It's for backup, or in case the power goes out, you have a limited amount of time in that battery storage. Okay, switchgear. So these are hardware components. These are cooling. These are very important plumbing kind of products. These are racks. Now, racks are like furniture made out of steel and aluminum. And that's where companies, if you look at a data center, they have these racks and they put in these really thin servers, and that's what they're operating with. Okay. So these guys are a hardware company, and we're going to look at their margins, okay, because that's going to be important. Here's a good depiction, and they kind of went away from it, of a data center. Maybe this will give me kind of a couple good pictures. So here's a, not quite, this is a little bit like made for Hollywood situation, but data centers kind of look like this, just not as pretty with glass doors and all that stuff. They usually have cages if it's a public data center, and companies will lease out a portion of that data center, and it'll be caged up and locked so that, nobody else can get in there, because you might have 5, 10, companies in that data center. Okay, so let's take a look at their financials and see what kind of fundamentals we're looking at. This stock has done well this year. It's done really well over the 5-year. The company's worth $69 billion with revenues of $9 billion. PE ratio is 86. That's a high PE ratio. Forward PE of 42. Very small dividend. It's a buy, but you're paying 16% too much, according to the analyst. All right, so financials. And their growth rate has been good. Okay. 26% is good. Revenue of 9 billion, Cost of revenue. So these guys are going to have okay margins. They're not great, but they're okay. They're in that category of 35% gross margins. Okay, that's okay. But if you bought it, NVIDIA does 75, 80%, Sterilabs does 85% gross margins. Palantir, almost 90% margins. That's great margins. 35 is just a little bit above bad. It's between bad and okay. 35%. That's an industrial product. That's a commodity-based business. It's not all that fantastic. Profit margins, they have high demand, so they're 14% currently. Free cash flow of 13.7%. So the free cash flow is 1.25 billion. And I think Vertiv is a stock that I do have a valuation on. So let me see if I do. So Vertiv has done really, really well because the stock market views companies that are touching that data center as highly desirable. The story is very investable by the market, but the fundamentals show that this business is just priced too high. I showed you how the margins are low. 35% is not very good. And if you have a slowdown in data center buildouts, or in their case, maybe they have Chinese rivals, competitors that come in with a lower price product that does just as well. And these data centers are like, yeah, we need to control costs at all times. And they're like, hey, sorry, Vertiv, we're going to go with a Chinese alternative, or Vertiv will have to lower their prices to compete. Right now, there's really good demand, so they're growing, but their growth isn't like off the charts. It's not like Astera Labs growing at 160% or NVIDIA growing at 100%. These guys are growing at mid 20% with low margins. So having said that, when I value this business, looking at the cash flow forecast, being very generous and saying these guys are going to grow nice and well for 20% growth rate. Not putting in here the threat of competition coming into their space. I get a 43% premium, meaning each share is worth $104 per share, but it's being priced at $182. When I look at earnings per share, I get a similar result where it's priced too high. And analysts themselves are saying it's priced too high. So I agree with the analyst. So this one's priced too high. Right now, the data center is getting so much investment. And it's one of the, I think, drivers of my concern is it's just going up. It's just too euphoric. It's not based on fundamental, hey, this business is not making a lot of money. Why is it going up so fast? It's not growing incredibly fast. Why is it going up so fast? I could understand like a business that is doing incredible things in the data center being rewarded, like you're growing 163%. Okay, now that's fantastic. That's superb. On top of that, we got gross margins of 75%. So these guys they're growing super fast, making lots of money, and they have very high free cash flow rates. Okay, this one I can understand the interest and investment in Astera Labs. I'm an investor in Astera Labs, but it's businesses like this that make me feel like it's going to end really, really hard on investors. When this thing, when they stop growing, they're like, yeah, we're a 35% gross margin business. Investors are going to realize, well, some of them won't realize what they're in. They're like, well, I thought it was a data center company. Aren't all data center companies supposed to be making a ton of money? No, not quite. Some of them make a lot of money per unit sold. Some of them make okay money. Some of them make terrible margins. And that's my analysis on Vertiv. What do you think about Vertiv, Daryl?
Well, this resistance line here is their highs. And you explained the fundamentals. So they're on a nice rise. They've broken out above that, and they're trading above an upward sloping 20, 50, and 200 day. They are overbought. They don't stay overbought very long. Here's a month. Here's about a week. This is looking over a year. Here's about a week, and another week or two. They don't stay that way very long. So this could be running out of steam, although they are gapping up today. Accumulation is pretty high, and they do have positive money flow. So I don't know how much higher it can run, and I'm questioning its momentum at the moment, even though they're gapping up.
Perfect. Okay. So thank you, Meredith, for the question on Vertiv. Hopefully you found the analysis interesting. We got comments coming in fast. Magical Self. So you're holding OBDC and ARCC for 4 years. They did okay for me as I needed dividends, but now I no longer care for dividends. So I know you did quite a bit of analysis on ARCC, and I'm not familiar with OBDC. Can you share your analysis on ARCC just to kind of get things flowing? And I'm going to do some homework on OBDC while you do that.
Yeah, and you might be able, let's see, who asked that question? Magical Self. You can go back and take a look at Wednesday's call. I think Victor and I both put timelines in, so you can jump right to ARCC. It was at the beginning of the show on Wednesday. So I've held this one also since I don't want to look at that. I want to look at ARCC because I've owned both of them as well. I sold out of OBDC a little while back, but why do I keep pulling up the wrong worksheet? Apologize for that. Let me get to ARCC. I've owned ARCC since 2021, and ODBC I also owned since about that time, and I sold out of ODBC at the end of last year. And so I've have a long history with this one as well. I have an average price of about $17.60 for the 500 shares that I've owned. I owned up to 1,800 shares. And you can see starting in November, I did quite a bit of selling. So I reduced it by 100, 250 shares, 120 shares, 80 shares, 60 shares. So I only have 500 shares right now, but all my trades were money makers. None of them are in the red. These would be red if it was a losing trade. So I made 26 trades on it, made $11,000, no losing trades. My current return's over 100%. But this one I could see was really starting to weaken. And here the last 2 months or so, it is down pretty big. Yeah, 15% or so.
Yeah, and here we're talking about Aries, and we're also going to talk about Blue Owl. What was the other symbol? And I did hear a really good investor that I respect on YouTube. He pointed out the main reason why these stocks are selling lower is an expectation that we're going to have much lower interest rates. So you think about the deals these guys are making, it's, hey, you want to expand and you need 500 million, we could be your capital partner and you can pay us 8% on that money or 9%. Well, in a year, 2 years, no one's going to pay you 8%. They're going to be like, no, we want to pay you 5%. We want to pay you 6%, because when interest rates really fall, Blue Owl and Aries Capital are not going to be able to charge the higher interest rates, which shrinks their profitability. It shrinks their revenue. It shrinks everything. So low interest rates are kind of limiting the opportunities for Aries as well as Blue Owl, because everybody's going to be chasing a lower yield going forward.
Well, he's asking now, I'm losing on both, but not sure to keep or sell. So if you think interest rates are going to continue to go down, you might as well sell now and cut your losses. If you think they're going to go down and somewhat stabilize, like I'm looking at a 3-year chart here, I could put like the TNX, which is the 10-year Treasury rate, and look at the correlation. Maybe I'll do that in a video just so you can see that analysis, but I probably have charts somewhere I can't pull them up quickly because I don't know exactly where I have them, but I've done that kind of analysis in the past because interest rates do influence the price performance of BDCs.
Yeah.
So,
Is it easy for you to go back like 10 years on this one?
yeah.
Because I'd like to see where this thing went around 2019.
So it was around 10, and in 2020 it dropped to
Yep.
4. So when the interest rates started going up,
Correct.
which was at the end of 2022, if I'm not mistaken, you
Correct.
can see that's what drove the price
Correct.
higher.
Yeah. Higher interest
And
rates.
yeah, now that they're coming down, you could either just cut your losses if you think the interest rates are going to continue to go down, or if you're going to hold it for, I don't know, I would say the next 5 or 10 years, because I think over the next few years they're going to go down, is my
Yeah.
belief.
I'm expecting interest rates for the next 3 years are going to be really low
Yeah.
because President Trump, he's going to be in office for 3 more years, right? And it's, I think one of the clear directives is he's going to get a Federal Reserve chair that is committed to low rates. And he'll really put a lot of pressure on that chairman to get rates down, keep them down. And then that's going to create positives on, for the economy if you look at growth and real estate and all that good stuff. But specific to ARCC and Blue Owl, that's just bad news. So good stuff on the charts. Let me come back to, so Blue Owl is a stock that we looked at, but we looked at it under symbol OWL. And this is a new issuance. I don't think they've been around for a long time. They IPO'd.
Keep in mind that OWL is the manager and ODBC is one of their management subsidiaries.
Got it.
Traded under 2 different symbols.
They're both down. OWL is down and OBDC is down. And I think, the market is wise to pick up on the fact that, hey, when you look at their financials, and as I like this new feature as reported by the company, what they are trying to do is create interest income to basically to create revenue for themselves. Interest income will go down. It's almost like you're selling, let's say Yeti, right? Yeti thermoses. They sell this thermos for, and this was given to me, so I don't know how much it cost. Let's say they were selling it for $50. And all of a sudden, the market's gotten so competitive. The best price they can do now is 25. Well, the darn thing cost them, $20. So their profits just went from being really good to being terrible. The profits go down, revenue goes down. It's not a pretty picture. So this is some businesses flourish with low interest rates. Some businesses struggle. And I think the trend is going to hurt both Ares Capital and Blue Owl going forward. I would not. And I did the analysis on Owl, and then I heard that really good investor talk about interest rates and he specifically talked about Blue Owl. He said Blue Owl had a great model when interest rates were expected to be higher for longer. And now that interest rates are going to be lower for a while, for like 3-4 years, where these businesses are going to struggle. So thanks for asking. Hopefully you found that really interesting. Thanks again for becoming a member. All right, good stuff. I think we got that one. We got VRT done. And we got OBDC. Done. Okay, we're moving. We are moving. Let me try to keep up with these comments because they're coming in fast and furious. DJ Stocks would like to look at GRAL and TTD. All right, we'll take a look at those. And let me check the comments. And Mike, great to see you. Devon Energy has struggled. And hopefully, Mike, you saw that we talked about EQT. We talked about the natural gas kind of expectations. That was early in the stream, if you want to look at the recording. But I think there's an opportunity in EQT as well as any pure play natural gas producer. EQT's been doing great. So Jack Lee. All right. I'm glad you caught the live stream. Great to have you. And Magical Self, thanks again for tuning in, becoming a member. Please keep bringing stocks. Let's keep the conversation going. So individual investors, we're doing great this year. And investing is difficult. And speaking for myself, and I think I speak for 100% of investors, some stocks we buy are not going to do great. They're going to do terrible. We got to realize it, and we got to learn from every experience, positive and negative. Even the great Warren Buffett, he's had a couple of turkeys in his portfolio, and he's had to sell them. And he's taken, one thing about Warren Buffett is, man, that guy has integrity. And when he buys a dog, he takes absolutely all the blame, and he just talks about, how it didn't go right. Now, he's also sitting on awesome winners that have just been compounding great returns. But even the greats buy some dogs. Even Michael Burry, he's bought some pretty good dogs lately. He's also bought some winners. David Tepper, he's killing it, but he's bought some bad stocks. So like them, we are going to buy some stocks where it's like, man, the market zigged when we thought it was going to zag. I thought they were going to do better than that. But like, eyes wide open, let's do our research analysis and pick up or take opportunities that the market's providing. Okay, we are moving on to GRAL. And once we get a moment, we're going to go over Amazon because Daryl's got some prep on Amazon. And we got to go over Volkswagen because that's a member request that was emailed to me. And I want to make sure we cover that before we run out of time. So Grail, commercial stage healthcare company, provides multi-cancer early detection testing services in the U.S. and internationally. It offers Gallery, a cancer screening test for asymptomatic individuals for over 50 years of age. All right. So early detection. Very good. Yeah, it's very important to detect these cancers early, and then the doctors can help people if it's caught early. All right. And is this like a consumer? You get shipped this product? So, you know how you have companies that are doing the whole DNA and they tell you like, hey, this is your lineal or genealogy of your family history and all that stuff. Well, are these guys doing the same thing where they send you something and you're basically doing kind of you're providing a specimen, you ship it in, and then they give you everything? It's kind of a consumer based service. That's what I'm trying to figure out. Okay. So it's part of the whole healthcare process. In addition to what has been provided, like your doctor says, hey, I want you to go do these labs. They're saying, hey, you should also do this, which helps go one step further in screening for cancers. Okay. So that's what we're dealing with here. Let's see if they're growing. Let's see if they're being recommended by doctors. It's a small cap, 2.5 billion. The stock's done well, 282%. The 1 year it's done fantastic. 2.55 billion, revenue 134 million. So you are paying up for the company. You're paying not quite 20, but maybe 18 times revenue. It's priced very high. It's been going up quite a bit, especially, geez, in the last month or so, it's up 86%. When did they announce earnings? They're going to announce on November 11th. There was probably some positive news. So these guys are growing like gangbusters. 142%. Phenomenal. And you see how they were selling into the market. They were doing a good job, but I think the market found out about them. And how is their revenue only growing sequentially that much? So 134. Yeah, I don't believe this number because from 93 to 134, that is not 142%. So let's see if this gives me better view. Okay, so something's off with the website stock analysis. It's good growth. I would call it fantastic if this was 50 or higher, but it's good, 35%. And it continues to grow. In the trailing 12 months, sequentially, it's only up $9 million. And that would include two new quarters blended into that number. So the growth isn't overly fantastic. Free cash flow is negative, but they're burning less of it. And profitability, gross margins. Whoa, what? That doesn't make any sense. Let's go to their actual website because those numbers are looking a little too erratic. So these guys are in Menlo Park, California. Where's your... All right, well, I have to look at it, find it a different way. Okay, so this is the CEO. That's fine. Let's find a financial statement that can help me understand what they're doing. All right, so Stock Analysis is is a really good website, but sometimes the numbers just don't come across as being correct. And on this occasion, they just look a little too unbelievable. Okay, so here we go. So the 6 months, if we compare last year to this year, the growth isn't tremendous. You see it's going from 58.6 to 67.3. So that's about $9 million. So if I divide 9 by 58, we get about 14%. That's not incredible. That's just okay. And this is where the losses are really eye-opening. So they're doing a lot of R&D, so they want to keep growing. So I'm going to check their balance sheet to make sure that they have enough cash to keep going. The cost of revenue is $66 million. Okay, so this number doesn't include depreciation, which is good. So they are making a decent margin. They're making about a 45% margin. Not great, but okay. And then when you include intangible amortization of intangibles, depreciation, you're barely breaking even at that level. But then they have research. You got to pay your salespeople and your marketing people, and then general and administrative. So they are losing quite a bit of money. Okay. All right. So they're losing money. It's an idea that is working, but it's not like, revolutionizing the space. It doesn't seem that way based on their growth rate. They do have quite a bit of cash. They have about $600 million of cash, combining the 127 and the 475. So that does give them a couple of years. And based on their growth rate that the market is using their product, they should be okay from a cash perspective. This one's really hard to value because they don't have any free cash flow. They're running with a lot of losses. So when's this going to stop, right? See if they give us a statement of cash flow. Here we go. Okay, so here's cash flow. So this is first 6 months. You had the losses. Okay. And it was negative $172 million from operations. They didn't have a whole lot of CapEx, only $431,000. So they're burning about, for the first 6 months, 172. The prior year, they were burning even more. So let's say this year they burned 250,000, 300,000, 300 million. They have about 2 years of cash left. So this business for me is uninvestable. It's just too much of a risk. I hope their idea works because it seems like they're going to help a lot of people, but it's really hard to get a valuation on these guys. And when we go to the forecast, we have two analysts looking at the stock, and they're divided on the price of the stock. One of them thinks 75, one of them's thinking $20 per share. I'd probably be with the $20 per share analyst because there's just too much risk involved. The company's going to keep growing at a decent rate, but it's only decent, and you're small, you're tiny. You should be growing really fast if you want to be successful. Because what if their bigger competitors look at their solution and can duplicate it, can create an alternative, but those companies have bigger relationships with big hospitals, big medical practices, and that competition can really hurt this business. This is a tiny cap, so the risk is inherent with small caps. The market likes them. The stock's been bid up, but I'm just not sold on the stock. I think it's not fantastic enough. Do you have charts on this one?
Yep. So I think the technicals are going to support your outlook here. They are surpassing their previous high, which was in February. So they did break out above that, which looks like a pretty good run. Is trading above a 21-day exponential moving average. It did have a downtrend that it broke above just shortly before it broke above its high. So about $48 versus about 55 or so. It did peak up to 63.99 on that high there, but that was just an intraday. And then it started to form somewhat of a cup and handle. You've seen me share these before. It didn't really form a handle here, so I don't know exactly what to think about that. But with a cup and handle pattern, you can measure down from the right rim of the cup, which is that dark blue line that I have there, and then add that to the price at the right rim, and that'll give you a target. And they've already exceeded that. So it was down about, well, let me see what I had. It was, anyway, it's already achieved it. It may not look like it if I'm looking at it visually, but this is a logarithmic scale. So it is in dollars. If you measure from the right-hand side down to the lower-hand side, it'll give you a dollar value, and then you can add that to the value at the right cup, and it'll give you the target. It's already achieved that. So why I even mention that is they're overbought right now. So the reward of them going higher is probably much less than them going lower at this point, although they are at least turning over. They do look strong at the moment. You have a good 5-day moving average, a good 21-day exponential moving average. The 50 is upward sloping. The 200 is upward sloping. We haven't had a bearish crossover. So everything's looking good there. But based on the risk reward, this is not one I would move into at this point. No, that would be my personal decision for a holding for me.
All right. So we're going to move to Trade Desk and then Verizon. But before we do that, you want to handle Amazon?
Yeah, just real quickly, because we talked about that on Wednesday.
Mm-hmm.
And after I left the call, I actually put a couple other trend lines on here. So we talked about this this trend channel, this horizontal trend channel, and how many times it had faced resistance and support.
Mm-hmm.
Then I went and added a trend channel, and Amazon has actually fallen out of the trend channel, which is always a little dangerous sign to me. Keep in mind, this is a short 2 or 3 year trend channel, but it has dropped out and trading sideways. So I've been talking about this one with another gentleman in the Discord, and we've been trying to figure out what the price target could be. And the implied move for the Friday options expiration following the earnings call is 8%. So that would be my short-term target. For an upside would be about 8% from here.
Mm-hmm.
So because this looks so scary, I went out and did a 20-year trend channel, and Amazon still looks very good using the 20-year trend channel.
Mm-hmm. Okay, great. So Amazon's earnings are going to dictate where the stock's going to go over the next 3 months. If they come out, and I think their data center growth was a concern on the last go around, and they can come back and kind of show, no, we're going to grow that data center and we're going to do other fantastic things, then we're going to be fine with Amazon. All right. Thank you, sir. So next one is the Trade Desk. We're going to move to Verizon, and then we're going to finish with Volkswagen. And the Trade Desk. The Trade Desk operates as a technology company. The company offers self-service cloud-based ad buying platform that allows buyers to plan, manage, optimize, and measure data-driven digital advertising campaigns. So this is ad tech, and this hasn't been a good year for these guys. Now, the the fall in trade desk, which is, it went from $136 a share down to 53. So this used to be a bigger cap. It was substantially bigger, like 70, $80 billion in market cap. Now it's 26. PE is 64. Is this an opportunity? Well, let's keep looking. And we're going to compare it to some of its rivals, most notably AppLovin. And so we are looking at a 63% discount based on what analysts are seeing. The company is growing 23%. When we look at the quarterly, you see a percentage drop. Now, that could be concerning, and I think their guidance was concerning that, hey, they're beginning to lose the battle against their rivals, and that is a concern. Now, the thing about trade desk is, you want to compare where possible against rivals in the industry and specific to that company. Give me a second here. All right. So, AppLovin has going in opposite direction. It's really going up in stock price because its revenues are just exploding and they're accelerating. So the acceleration in growth from AppLovin, this is a direct competitor to the trade desk. So knowing that
Victor, you've got a spammer in the chat. You might want to delete that last chat message.
Okay. And I don't know how to do that. So only guess. So I'm not sure how to delete it.
We can just ignore it.
Yeah, I'm going to have to do some homework there on how to do that. So, and it came through X. So how do I delete that? Well, it's the first time that's happened.
Yeah, as your channel gets more popular, you can expect more and more of that. So unfortunately, that's the way people play.
All right. So, and maybe I could just cut off. All right. Sorry, guys, on X, but I'm going to have to cut it off. All right. Hopefully that cuts it off. All right. So getting back to the trade desk. So the revenue growth is decent, but the stock market is looking at this business being vulnerable. The revenue loss is a problem, and AppLovin is really cleaning up. That's one of the main concerns I would have with the trade desk. I think their stock's probably going to value well, especially since the stock price has been dropping so much. But I think these analysts got to update their forecast. The revenue isn't going to be overly impressive, 17%. And the PE ratio, if they increase their profits, will look quite attractive, but it could be a problem. So looking at, I think I have the trade desk. Is discounted by 20%. Now, is it worth that risk? I don't know. I think it's in the right space. Like it's a good company that makes good profits, and but it's just not good enough. And AppLovin has been a really good investment for me. Like I bought the stock and it rose. And the other company I'm playing is Zeta, which has better growth, lower market cap. There's a lot of alternatives within Trade Desk's industry. So I think there's just better options within this particular industry to invest in. So Trade Desk for me is a sell. It's not something that's investable for me. There's better choices out there. Zeta's discounted and AppLovin is killing it. They're doing so well and they deserve it because they've been growing really well. They have high profitability, all the things that we're looking for. Any comments on the Trade Desk?
Well, the charts support what you just said. So it's an indefinite downtrend. The 200 days downtrending, the 50 days downtrending. I've got two trend lines that show you did have one little breakout and then had the rug pulled out from under you. It did break out above this downtrend line, so that may have been a good entry point, but I think your fundamental analysis and the opportunity cost of not choosing one that's a little bit better in this space, this is a pretty risky one, and the chart is showing that as well.
All right, so that is the Trade Desk. All right, so let's keep going to Verizon. Verizon has been looking good. Verizon's a good stock for an investor that's looking for income. Pays a 6.7% dividend. And year to date, it's flat. For the 1 year, it's down. For the 5 year, it's down 32%. This is one of the big telcos. 168 billion in market cap, almost 1-to-1 on revenue. PE is super low. I like Verizon more than AT&T and more than
T-Mobile.
T-Mobile. Thank you, sir. You rescued me. And analysts think it's discounted by 21%. And I'm going to show you my valuation in a bit. Their growth, you're not expecting big growth because this is a high revenue business that's just trying to take subscribers away from AT&T or T-Mobile or elsewhere, or maybe a new subscriber because a teenager needs a phone now. So you're not expecting high growth, but this is more of a value play. You know, where is this stock's going to benefit an investor in the form of income and stability. It's already had a sell-off. It's expected to continue to grow and expand its profits single digits, but their PE is super low. And if we get into any kind of pullback recession, these stocks tend to do well. All right. So
or when the interest rates on bonds start coming down or treasuries, then people will move to stocks like this because their yield is higher.
Correct. Yeah, because man, you're not going to find a low risk bond that's going to pay you what Verizon's going to pay you. All right. So Verizon, in my opinion, is discounted by 35%. That's a pretty good discount on a very well-known name. I think it's low risk. So it could probably, over the next year, 2 years, go up 5 to 15% per year in price appreciation and pay a nice dividend. So that's what we have on Verizon. What are the charts showing on Verizon on your side?
Well, it has been trading sideways. The 200 days still moving up. The 50 days turning down. The 20 day is also turning down. It's getting way oversold. And I own AT&T because they're my provider. So that's why I stayed with AT&T. I did really well this year with AT&T. They had a really large price appreciation, but we're seeing this similar performance here as we are with Verizon. So I actually trimmed a pretty good chunk of my AT&T at the beginning of this month, and I'll wait for it to pull back and stabilize before I step back in, because it will be an opportunity if the treasury rates come down. People will be looking for yield, and Verizon and T are both, they have pretty high yields.
Excellent. All right. And to finish off, we're going to go over Volkswagen. The car companies, the legacy ones, they're a tough investment. Volkswagen is 53 billion in market cap, but the revenues are 380 billion. So they're just pricing the whole business at a fraction of total revenue. PE is super low. And these guys are, of course, a European company. And the 5-year doesn't look good. The 1 year doesn't look good. They pay a dividend of 4.23%. And then the year to date looks pretty decent. Is that going to continue to go higher? Their revenue is not growing. And I think this year in particular, I think the third quarter is going to be good because there's big push, I guess, in the US specific, that a lot of people are buying cars to take advantage of the EV incentives. But after that, I think it's really going to fall off. So I don't know that growth is going to be all that great for the whole year. And when we look at margins for this business, not very good. 16%. These are just terrible margins. And profit margins are really terrible too. And no free cash flow. So I can't even value Volkswagen because they don't have any cash flow. And when I look at the historic cash flow, it's all over the place. We've had a negative number, big numbers, and then low numbers, which is unfortunate. So I think this one here, I can't value on cash flow. I tried to give it the college try, but it just wasn't in the cards. When we look at, and I don't have any forecast from analysts. I only can use their historic earnings per share. I did value the company, and just based on earnings per share, the earnings per share are really low. I can't get anywhere near their stock price. I think Volkswagen is a recognizable brand. I get that. And investors are willing to buy the stock, but I can't place a value based on cash flows because there's not enough consistency in the cash flows they were producing. It's really low margins. It would be a complete guess if I were to guess, oh, this is what they're going to do from cash flows. So for the investor that wanted me to look at Volkswagen, I put quite a bit of time in trying to figure this one out, but I just couldn't get there. So I can't value it based on cash. And the earnings per share, it doesn't look good. Doesn't look good at all. So I'm not in a car manufacturer right now. Ford looks better. If you're interested in a car company, Ford does look better at a 66% discount, and it pays a nice dividend as well. So that's my analysis on Volkswagen. Any comments on Volkswagen?
This is an ugly chart. So I have my cursor sitting where the price is trading today. And if you had bought it in 2007, you'd have paid the same price, and 19 years later, you'd still have your capital left. And looks like a little bit of dividends, but not many. This is a disaster. That's my technical analysis opinion.
All right. Short and sweet.
Yeah.
All right, everybody.
Let me
So
look at Ford real quick.
okay.
Yeah, I mean, you would have done a little bit better, but not much. I don't buy car companies, in case you couldn't tell. I don't know what else to say about this one.
Yeah. Yeah, you got it. I think car companies are tough to invest in.
Yep, it
And
is. It's a tough one. It's just definitely not for me.
okay. All right. Well, we made it to 11 a.m. Eastern, 8 a.m. Pacific. The market is, boy, it's gone negative. Look at that. Amazon's down, Meta's down. Things have gotten a little more. We were trading high, by the way. What happened? Something had to come out. There's some news out there, but looks like we're going to trade lower today. We'll see how low. All right. All right, everybody. Well, thanks for tuning in. I really appreciate it. And hope you have a really nice weekend. We had a lot of good stocks being requested. And I really appreciate that. I appreciate that we got 2 new members to join. Thank you so much. And thank you for all the existing members. And we'll stream again next week, same schedule. We'll see if we can mix in a couple of watch parties for earnings, and we'll go from there. All right, everybody.
Just a quick programming note. The bond market will be closed on Monday, the U.S. bond market. The stock market and everything else will be open, but the bond market will be closed.
Excellent. All right. Thanks, everyone. Have a great day and a nice weekend.
Take care, everyone.